How is it that in 2023, when 70% of economists were expecting a recession, the stock market had one of its best years in recent history? And more importantly, will this momentum continue into 2024, or is a recession imminent? Experts predict that 2024 will bring a major turnaround in the stock market because something will crack. You see, in the current macroeconomic environment, it's almost unanimous between experts that something has to give. So, let's see what the economists from the biggest investment banks in the world predict and how you can use it to navigate the volatility in the stock market in 2024. And the first thing that economists agree on is that the Fed is done with the rate hikes and the peak of interest rates is behind us. And to understand why this period is so difficult, we need to see everything through the Fed's eyes. The Fed had only one objective for 2023, which is to lower inflation.
We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time.
And so far, they've done great progress. Personal consumption expenditures, or the PCE index, just came in at 3.2%, while core PCE came in at 2.6%, both sitting below expectations. And the progress has been so good that the Fed will begin cutting rates in 2024 when they expect inflation to be around 2.4%, and here's where the first problem arises. You see, because the Fed raised interest rates at the fastest pace in history, everything in the economy became much more difficult. Because Fed must give away something in exchange for low inflation, and they are forced to give up economic growth. We simply cannot have high economic growth and interest rates sitting at 5%. And while this might seem like a fair trade, it's not that easy, since the Fed doesn't fully know what it's doing because there is a lag between their monetary policy and the economy. And that's the second thing that all economists agree on. Right now, Jerome Powell is driving a bus at a high speed while being blindfolded, and he must stop the bus right before it jumps off the cliff. But since he's blindfolded, it comes down to his gut feeling. And that's exactly how the economy works. Because Fed now has a dilemma. They don't know how much to slow the economy before triggering a recession. Because unfortunately, the effects from the rate hikes done in 2023 have yet to be felt by the economy.
The full effects of our tightening likely have not yet been felt.
Economists estimate that the impact of elevated interest rates in conjunction with the quantitative tightening, which means that the Fed is pulling liquidity out of the market, will begin to weigh on growth in the coming quarters and will lead to a higher number of bankruptcies and a weaker job market. And because of this, the market is also having a dilemma. The stock market anticipates the first rate cut in March and a total of 6 rate cuts in 2024. There are only 2 scenarios in which the Fed will cut interest rates that quickly. First, if inflation is close to their target, which means that Fed has done everything right and they got the soft landing. But it seems too soon to call victory, so the second scenario for which Fed would cut rates is because they know they've destroyed something in the economy. Economists from Charles Schwab warn that if the Fed would cut rates before June 2024, it's because of deterioration in the economy, more specifically in the labor market. They estimate that in 2024, the Fed will change its focus from lowering inflation to its other major objective, keeping a healthy labor market.
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people.
And if the Fed broke something, it would mean that the US economy will not grow in 2024. But on the other hand, FactSet shows that the market anticipates a 2024 EPS growth of 11% for the companies included in the S&P 500. Now, an 11% growth fits the soft landing scenario, but we can't have lower interest rates that soon and strong growth for 2024. And the economists tend to agree. Morgan Stanley anticipates the first rate cut in June, Charles Schwab and Bank of America sometimes in the middle of 2024, and Goldman expects it in the third quarter. So, they agree that the market's expectations are too optimistic. But one thing that's certain is that the goalpost keeps moving. At the beginning of 2023, after the collapse of Silicon Valley Bank and SoftBank, expectations were that the Fed would be cutting rates by the summer. Obviously, that didn't happen, but one thing that happens every time before a rate cut is a slowdown in the economy. Almost every other time in history, rate cuts came after something seriously broke. Morgan Stanley warns that stocks typically begin to sell off 3 months before a new round of monetary easing, as risk assets start anticipating slower growth. If central banks stay on track to begin cutting rates in June, global equities may fall in early 2024, but if Fed will cut rates in March, we might see a decrease in equities starting as early as January. Economists from Schwab also estimate that economic pain is probable in 2024, advising investors to not fight the Fed, as higher rates for longer is the mantra now. But if interest rates are at their peak for several months and giving the bankruptcies at the start of the year, you might be wondering why we didn't have a recession yet. But actually, we did. It's just that it was a rolling recession. This means that only some sectors of the economy were hit. And in 2023, we've seen a manufacturing recession, as shown by economists at Charles Schwab, who call it a cardboard box recession. It is obviously from the falling production output for both Europe and the US. Moreover, the Global Purchasing Managers Index, the PMI, set a new record of 15 months of contraction. This is the longest streak in history, only tied with the downturn in 2000. But the reason why this didn't turn into a full recession is because the economy was stronger than expected on the side of supply.
This was the year when labor force participation picked up, where immigration picked up, the shortages and the bottlenecks really began to unwind. So we had significant supply-side gains with strong demand.
Moreover, BNP Paribas argues that demand remained strong because of massive fiscal support and consumer having excess savings. But now, they're both gone. Additionally, we have high interest rates and low wage growth that will also weaken the consumer. And with consumer spending accounting for about 70% of US GDP, this will be key to whether an official recession can be avoided. Considering all that, there are only 2 possible scenarios for 2024, so let's see what stocks should we buy for each of them. Firstly, there's the scenario where this rolling recession continues. Services, which we can see here with blue line, might crumble since they've had a lag as they've recovered later out of the pandemic. Since the services sector is the biggest employer in the US, the strength of this sector will decide if the US will face a rolling recession, and 50% of the economists estimate that it will happen in 2024. However, not everyone agrees, with Charles Schwab assigning a low probability, while Goldman has a 15% chance of recession, all the way up to Fidelity, which estimates a 60% probability of a rolling recession. On the other hand, analysts from JP Morgan, Citibank, Wells Fargo, and BNP Paribas argue that a recession will not happen in 2024, but they all warn that the first half of the year will be bumpy. Goldman estimates that in the scenario of a rolling recession, the S&P 500 will drop to 3,700, which is a massive 22% drop. However, real recessions reflect contagion, and typically they need a catalyst either in the labor market or in the financial system. So, in 2024, economists advise us to keep a close eye on the leading labor market indicators like the unemployment claims and the credit market. These 2 indicators will decide if the recession has been avoided or if it has simply been delayed. But luckily, we are not there yet, and the markets remain optimistic. And speaking of optimism, the second scenario is that of a soft landing. In this scenario, manufacturing picks back up and growth in services doesn't slow significantly. Moreover, unemployment rate will not surpass Fed's target of 4.1% at the end of 2024, and there will be no major default crisis. This is the best possible outcome, and the market has already priced in this scenario becoming reality. Bank of America calls 2024 the year of the landing and estimates that Fed will stick the soft landing. UBS predicts that the US will achieve a softish landing, thanks to robust labor demand, solid investment spending, and stronger consumer and businesses' balance sheets. So, as a recap, what do these economists recommend us to do in 2024? Well, the first thing that most of them recommend is to stay invested. Goldman took a page out of Taylor Swift's book and tells us to just stay invested. Citibank argues that it would be unfortunate to miss this moment, as many asset classes will recover, but they recommend us keeping diversified portfolios. JP Morgan expects some of the momentum from 2023 to continue, so they are also recommend us to stay long equities. But to see if 2024 can be another bull year, we need to understand why 2023 offered such strong returns when nobody expected it. Remember, 70% of the economists were predicting a bearish scenario, but the US stock market was strong only because of the Magnificent Seven, which are Meta, Amazon, Apple, Microsoft, Google, Tesla, and Nvidia. At the end of 2023, the S&P 500 returned 26%, but without these 7 stocks, the return would have been of only 10%. These stocks have been lagging in 2022, but they came back in 2023 because of their faster than anticipated growth, high margins, good reinvestment ratio, and strong balance sheets. Goldman estimates that these might continue to outperform in 2024, but they trade at a 27% premium compared to the S&P 500, and this will limit their upside. Instead, JP Morgan focuses more on other large caps that have already been through a recession. Now these have emerged with leaner cost structures, which should help them face a slower demand in 2024. But when looking at their valuation, that's where economists have different opinions. While Goldman, BNP Paribas and Morgan Stanley argue that valuations are elevated compared to expected growth, JP Morgan's economists argue that the price-to-earnings multiples can still provide upside because the S&P 500 companies have now 30% higher free cash flow margins compared to 10 years ago. However, since the market has priced in the soft landing scenario, valuations probably won't increase much, as the only source for upside will be better than expected earnings. But the one thing that all economists recommend is to buy quality stocks at least until the economy turns. Goldman recommends quality stocks with high profitability, strong balance sheet, stable sales, and earnings growth. UBS is also looking at quality stocks with strong returns on invested capital, high operating margins, and low debt. They recommend the US IT sector, which should do well in a slower growth environment. Charles Schwab anticipates that stocks with low price-to-cash flow ratios may outperform in 2024, as these are more concentrated in financials and energy. Moreover, they argue that quality is cheap, especially for the quality small caps. But instead of recommending the Russell 2000, which is the US small cap index, they recommend the S&P 600, which is constructed with a profitability filter and represents a high quality source of ideas for stock pickers in 2024. Moreover, Citibank made a comprehensive list with the top 10 investments for 2024, and it's surprising how high they put cybersecurity. They see the growth of AI as a tailwind, and spending on cybersecurity remains a top item in IT budgets. I made a video showing the best cybersecurity stocks you can buy, and you can watch it right here. However, if the economy slows down more than expected, investors will be tempted to pick riskier stocks. A rolling recession will force Fed to cut interest rates, which would make the long duration stocks grow. These are the companies growing fast that will create most of their value in the future. BNP Paribas put these long duration stocks as their highest conviction for 2024 if the growth will be weaker than expected. Charles Schwab argues that there are tailwinds for small caps in 2024 because they have already endured a bear market and valuations are now attractive. However, small caps have historically outperformed when unemployment was high and the economy was transitioning out of a recession, but we are not there yet. Still, please keep in mind that nothing is 100% sure in the stock market and there can be a hard landing happening at any point in 2024. To sum up, there are a couple of things that all economists agree on. 2024 will be a difficult year for the stock market, especially in the first half. Generally, the stock market drops 3 months in advance of the first rate cut because it prices in lower growth. So, we will have a clearer picture after the first quarter of 2024. But until then, quality stocks are the best picks. And since we can't know the full effects of the interest rate hikes done in 2023, we need to follow closely the unemployment rate, the consumer spending, and the credit markets to see if a recession will materialize. But so far, inflation is coming down, unemployment looks good, and there is no major credit risk in the market. So there seems to be no reason why we should get out of the market, so we should let Jerome Powell do his thing. If you enjoyed this analysis and you want to see more videos like this, please hit that like button and subscribe.